Hello, learners. Welcome to today's class. And I want to welcome you again to the song group, Study Addict Networking Group. I want to thank you for also following us on our Facebook page and all or some of our social media platforms. My name is Mr. Adesanmi, and I'll be taking you through business studies today. Now, this class is an introduction class mainly for junior secondary school or junior high school, as the case may be, meaning from grade 7 down to grade 9. So, today we'll be looking at a very interesting topic, which is called source documents. Source documents. Now, what I'll be sharing with you on this topic is some of the importance of this document to bookkeeping and accounting in general. Remember, in our last two series, we looked at the topic bookkeeping, the definition and its importance, and who a bookkeeper is. So, this topic we're about to watch is related to the topic on bookkeeping. So we'll be looking at source documents today. Source documents. So I kind of emphasize the importance of this document because without this document, then the other accounting books will be useless. Without this document, the other accounting books that you will learn to know later will be useless. So this is the primary book of accounts itself, the source document. So to a layman, what are source documents? The documents you keep. These are documents you should keep in order to record transactions from them into your bookkeeping records. So the documents you should keep in your bookkeeping records. So as I've said, these are for beginners and they need to know this source document. So without this source document, vital informations or vital transactions might not be able to be recorded. So what are source documents? What are source documents? Now, source documents are documents which provide original or first-hand information used in preparing accounts. Source documents are documents which provide original or hand information used in preparing accounts. So based on this information, and take note of those words in red. These are original information. These are first-hand information. These are primary information needed to prepare the accounts. So without this first-hand information or without this primary information, then preparing other accounts might not be possible. So this document helps in the following ways. This document helps to support reliability. There are documents that are reliable. So without this document, a lot of issues in accounting might not be able to be solved. So this document supports reliability. So this information there in this document should be free from errors, should be free from bias, should be free from your personal options, should be free from your own estimation. It's based on data that can be checked and verified. Remember, under the quality of a bookkeeper that I told you that a bookkeeper must be honest, a bookkeeper must be transparent, a bookkeeper must be accountable. Now, with the help of this source document, a good bookkeeper can check and verify and confirm the sources of such transactions. So if it can be checked and verified, then it shows that that bookkeeper is accountable. So having a source document to verify all this is very important. Having a source document to verify and check all transaction is very important. So we'll be looking at some of these source documents, from your receipt to your check to your invoice to your memo to your statement of account. All these are some of the source documents we will be looking at today. So take note, they serve as documentary evidence for cash and transactions. So your source documents serve as a documentary evidence for cash and credit transaction. Now, if you remember, I told you that there are two types of transaction. We have the cash transactions and we have the credit transactions. Now, your cash transactions are those transactions or those buying and selling that involves money. Meaning, when you are making such transaction, money is used as a medium of exchange. Money is used to exchange that item for the other. It is called cash transaction. Now, for your credit transaction, money is not used immediately. Meaning you buy an item without paying money immediately. So we call that credit transaction with the hope or promise of paying later. Meaning you bought that item on credit. So these two transactions have their source documents. These two different transactions, be it your cash transaction, be it your credit transaction, have some document which is used in processing those goods and services, and they are called source documents. So we'll be looking at the types of source document, Generally, we have a lot of them. So quickly, let's look at them. So we have from your invoice down to your receipt, from your receipt down to your check, down to your deposit slip, down to your payment voucher, down to your debit note, your credit note, your bank statement, your credit card statement, your loan statement, your employee time card. And as I've said, we have a lot of them. But for the purpose of this class, we'll be limiting our explanation to some of these. We have about 9 there. So invoice, we'll be looking at invoice, receipt, debit note, credit note. We'll be looking at checks. We'll be looking at purchase order, cash receipt, cash slip, and then we'll be looking at a petty cash summary. So now, if time permits, we'll look at everything there. And if not, we'll be taking some important source documents. So take note that source document helps to record transactions, be it your cash transaction or your credit transaction. Now, all these source documents that are listed can be classified under 3 headings. This source document from number 1 to number 9 can be classified under 3 different transactions. So looking at this diagram, you see there that the first one there is your cash transaction, while the second is your credit transaction, and then we have the others. Now, under your cash transaction, these are, as I've said, these are transactions that involve money. So there are a lot of documents that support this. So, but for the purpose of this diagram, I just listed 2 there. We have your cash receipt and your check. These support cash transaction. While for your credit transaction, we have your sales invoice and your purchase invoice. These sales and purchase invoice are issued when credit transactions are made. While other documents that can be classified under either cash or credit transaction, but they are used in order to mobilize and monitor the movement of goods. from the buyer to the seller, or from one person to another. Yes, we have a lot of them. So we have there your memo, we have your statement of account, and we have your order, we have quotation. All these are also part of the source document. So now we'll be looking at the source document, proof of cash payment for an account. So all these are source documents when cash transaction or cash payment is being made. So we have from your deposit slip to your receipt, to your still slip, to your checkbook, and to your petty cash. So receive cash. Now these are the duplicates you are to give out, and pay. In some cases you give duplicate, and in some places when cash is paid, original will be issued. So and we all know that in the bank as well, cash counterfoil will sometimes be issued as well. So all these are your source documents when cash transaction is being made. So take note of this, that source document, as I've said, is the primary book of accounting, or in some cases it is called the first-hand book of accounts, or the original book of account that provides information from the primary level down to the other level, so that accountants will be able to get the source of the information. Not only getting the source of information, it's very easy to trace this account. Now, without this source document, other accounts or other ledger might not be possible to be able to calculate. Now, let's see the movement of your account transactions. The movement of your account transactions. So take note. The first there you can see is your source document. So information or transaction moves from your source document to your books of primary entry. Now, example of your source document, which I've said earlier, is your check, your sales invoice, your supplier's invoice, your receipts, and your quotations, and name them. All these are source documents. So information moves from there to the books of primary entry, which are your cash book, your petty cash book, and then other books. Then from there it moves to your ledger. It moves to your ledger, where we have sometimes your account, your cash book is also a ledger because it has the debit side and the credit side. So information moves from there even to your accounting receivable ledger, and from there it moves to your reports, which are your trade balance, trial balance. We have your balance sheet. We have your trading profit and loss account. All these are reports accounts. So those are the final book of accounts, which show a summary of what has happened in an organization. That's very here. So information move from your source document down to your report. So if the source document does not provide adequate and genuine information, the other books of account will be affected. And that is why the source document, which provide first-hand or original book of transaction, is very, very important. It's very important. So let's look at the first source document. Is invoice. Invoice is one we'll be looking at quickly. So what is invoice? What is invoice? So an invoice is a commercial document. An invoice is a commercial document that itemizes and records a transaction between a buyer and a seller. So an invoice is used when buying and selling takes place. So an invoice is a document that lists items bought and sold. So it shows the transaction of items that are bought and sold. It provides details about sales or products, which include the following information you see in your invoice: quantity and description of goods but we'll see unit price, total price, discount, if any, net amount payable. We also see term of delivery. All these are information that you can see in your invoice. So, as I said, it's a commercial document that shows that sales has been made. So, between the buyer and the seller, it shows a description of such transaction, description of goods, the price of goods, and the amount payable. Now, it looks like something like this. That's how your invoice looks like. Starting from here, which talk about the name and address of the organization, going through the dates there. You also see the invoice number there. Then back to the customer's name and address will be there. In some cases, uh, the business logo will be here in some cases, and sometimes there in some cases. So also here you will see the description of items bought, the description of items bought there with the amount, and then calculating this together will give you this total here. So here is the total, so meaning $300 plus $1,500 will give you $1,800. So now going down a little, you see term of payment and payment due date, and then after that you see calculation. So this is how sometimes a invoice looks like. So all this information must be in on a good invoice. All this information are very important. So let's look at a good example of an invoice. Good example of an invoice. So going a little bit down. So this how it looks like. So here you can see the number, the name of the organization, the organization, the invoice number. Now the delivery note of delivery. We'll see who is in charge. Then going down, we'll see goods bought, the description of goods bought, the rate and the amount. And then the total amount of goods bought is 570,000 naira. Taking note of the description of goods there, of office desks, we have armchair, we have coffee table, and we have bookcase. The rate is per one. Rate is per one. So you can see the quantity there of goods bought, quantity for each of them. So when you times your quantity times rate to give you the amount. So for example, for your office desks, quantity bought is 10 and the rate of one is 24,000. So when you times 24,000 times 10 is to give you 240,000. The second is armchair. Quantity bought is 10 and the rate per one is 5,000. So when you times 10 times 5,000 it will give you 50,000. The next is quantity of coffee. We bought 10 there and the rate of one is 10. So 10 times 10,000 will give you 100,000. So for your book case, quantity bought is 6 and the rate of one is 30,000. So when you times your 6 times 30,000, it will give you 180,000. So when you had your 240,000 plus 50,000 plus 100,000 plus 180,000, gives you 470,000. So this will be written in words, and then there'll be a portion for prepared by who prepared this. Who prepared this, and then which checked it. And in some cases, you'll see a slot for customers types of invoice. We have invoice. So, but for purpose of this class, you'll be looking at one of them, which we'll be looking at later, not now, not on this video. So we have let's start from we have inland invoice down to foreign invoice, down to inward invoice, down to outward invoice, and the last one we'll be looking at later, probably not on this video, will be pro forma invoice, which is very common. Pro forma invoice. So all this invoice, you should know. But for your level now, as you are still in the junior school, the one that is very important for you to know now is the pro forma invoice, which will be discussed later. So let's look at the next source document, which is receipt. It is a very common document which we can find in our houses. Now, anytime we involve in any form of transaction and we pay cash immediately, this source document is always issued. This document is always issued. So the question is this: what is receipt? What is receipt? A receipt is a document which confirms that payment has been made for goods or services purchased or enjoyed. A receipt is a document which confirms that payment has been made for goods or services purchased or enjoyed. So when you purchase goods and services and you pay, meaning cash transaction, you make payment, a receipt will be issued for that to show to whoever cares to know that that product now belongs to you, or the services you have enjoyed, you paid for it. So it's mainly for goods and services paid for. So that is why receipt is one of the important source documents. It's one of the important source documents. So now your receipt can come in cash. We have different receipts as different receipts. So your receipt can come in cash receipt. We have the cash receipt. Sometimes we have the sales receipt. Sometimes we have the house rent receipt, which we'll be looking at. But every time a firm receives cash inflow, every time a firm receives cash inflow, a cash receipt is issued to the other party. So anytime a firm receives cash inflow, okay, from a customer or an agent or whoever pays the company or the organization or the firm money. So firm money is coming in to show that the firm has received that money. A cash receipt is issued to that firm. Now, your receipt contains some of this information. The receipt usually contains the following information. We have date of payment and reason of payment, meaning dates you paid the money and why. What the description? Why do you pay the money? Is it for goods purchased? Is it for rent? Is it for services rendered? So depending on the reason why you made that payment, the name of the payer will also be on the receipt. The amount paid in words and figure will also be on the receipt. And then signature. Sometimes signature of both the seller and the buyer will be on the receipt, and sometimes it's just only the signature of the customer, meaning of the buyer, that will be on the receipt. Now, this is a good example of how a receipt look like. You see there, it has receipt number and date. We have receipt from the name of the customers will be there. It will be there. The customer or the buyer will be there. Amount in words will be here. So we have current balance, amount paid will be there, then amount due. That depending on if the person is paying for everything or is making part payment. So received by signature and the name of that person will be there. Now, depending on if you are paying cash, share, you are using check or money order, any of these boxes will be ticked. So this is just one design of a cash receipt. We have a lot of designs of a cash receipt. So another one is, some can look like this, which also contains the name and address of the supplier, the date of purchase, the items list of purchase, VAT, depending if that VAT means your value added tax. If applicable, then your total price. So a receipt can also look like this. So we have under type, under a format. This is sales receipt. Sales receipt. So this also shows the date, the quantity, and the description and amount. So in this case, we have one of everything of your bicycle, of your spare bicycle tire, and of your cycling gloves. So one of each is bought, and that is the amount. So the total of 250 plus 25 plus 25 gives 300. Now a value added tax of 10% was removed, was added to it. Value added tax of 10% was added to that. So that gave us 330 naira or dollars, as the case may be. 330 naira or dollars, as the case may be. So pay with, depending on what that person wants to pay with. But in this case, that customer, you can see the X on cash. So if it's to pay with either credit or debit card, that would also be starred. If it's a check is using, the check number will be written there, and how much is paying will be written there. And if it's a bank transfer, that place will also be ticked. So another example of your receipt is your rent receipt. That's your house rent receipt, how it looks like. So almost the same format, almost the same format. So take note, they have date and receipt number in common. Receipt from, meaning the tenant now paying the landlord. The name of the tenant will be there. The amount payable will be there. From which date to which date? Is it paying in cash, or is it using check or money order? Receipt by, the address, phone number. So now all these are good examples of your receipt. Now a good question is this: what is the difference between your invoice and your receipt? This sometimes causes confusion even among adults. So but I want to help you out with that. The difference between your invoice and your cash receipt, or your sales receipt, as the case may be. So but purpose, because of time, and because I just want you to gain something, I will be giving you just three. You can do more assignments yourself and then add more to it yourself. So number one, an invoice is a request for payment. So now if you go to a seller shop and you point to this item, I want to buy this, I want to buy this, I want to buy that. Okay, now the seller of that commodity or the supplier will bring them out and fill up the invoice. So once the invoice is filled up, the information there is, the description of the goods is written in the invoice. It will be handed over to you. So that shows that it's requesting for payment. Take note, payment has not been made. Sales have not been made. So at that point, you can decline that you're not buying again. At that point, you can say, oh, this is not the goods I ordered for. I ordered for black, you're bringing white. So I can't take that invoice. So an invoice is just a way to request for payment. That does not mean payment has been made or sales have been made. But once a receipt is issued, it is approved that payment has been made. So that's number one difference. So an invoice is a way to request for payment. A receipt is a proof that payment has been made. Number two, an invoice is issued before payment is made. Take note of that. An invoice is issued before payment is made, while a receipt is issued after payment is made. So invoice, as I've said, shows that you are requesting for payment, while a receipt shows that payment has been made. So you issue a receipt after payment. Now, an invoice is issued before payment. Number three, an invoice is used to keep track of goods and services sold. So let's assume you ordered for some item on your e-commerce. A good example is your Jumia, or you ordered from OLS or from Konga and all other e-commerce platform. Now, an invoice will be issued, which you can print out to track. They will give you a tracker number where you can track the movement of your goods from one place to another. So giving that invoice does not mean you have made payment. No, it just shows that your goods have been dispatched and that truly you have ordered for such goods. But take note, you've not made payment. So, and that does not mean sales has also been made, because the goods can get to you through the dispatch rider, and you might not be satisfied with the quality or quantity of such commodities. But a receipt, on the other hand, acknowledges that payment has been made. So a receipt acknowledges that payment has been made. So when a receipt is issued, it shows that that buyer has made payment. So let's move on to the next source document, which is check. Check is our next. So I believe you guys have seen how a check looks like. So if you have not, you can meet daddy or mommy to give you their check and just flip through it. But of course, I'll be giving you samples of check. So what is a check? A check is a written order to a bank to pay a certain amount of money to another person. So a check is a document that orders a bank to pay the bearer of that check a certain amount of money, the amount of money written on that check. So a check is a written order to pay a bank a certain amount of money to another person. So check is widely used in the world, especially if large amount of money is involved. Imagine you are trying to buy a property worth of 70 or 80 million naira or dollars. You can't carry such money around. You either issue a check or you do a bank transfer. So check is commonly used, and it is used through your commercial banks. Now, all over the world, we have banks like First Bank, we have UBA Bank, we have Zenith Bank, and a lot of banks. So all these banks receive check on a daily basis for cash transactions. Now, a check contains the name of the bank, check number, name of payee, which I will be telling you the meaning of that later, amount in words and in figure, date, and the signature of the drawer. So all these are information needed in a check. So take note that a check is also a source document. A check is a source document that supports accounting entering from the payment point of view. So a check is also a source document. Take note of that. So let's look at an example of a check. So see that number one, I believe you can see the number. Let me try to enlarge for you. Okay, so number one, we have the First Bank of any of the country. Okay, so this is wiki now. So now that's number one. Some of the vital information you see on a check: the name of the bank. Two, the name of the person collecting the money will be there. For example, if you are paying me a check, then you write my name there, and the amount in what written there. Number three, the date. Number four, the amount in figure. Number five, you can see it is printed. That's the owner of the account. So number six, the person you have to pay to. And number seven, the check serial number. Very, very important. So this is a good example of a check, and this information are needed for your check to be cleared. So this must be written in this order, and no shading, no canceling, because once you do that, then that check will be dishonored when you present it. that check will be dishonored when you present it. So let's look at parties to a check. Parties to a check. Meaning before a check can be issued, these parties are needed. We have the drawer, we have the drawee, and we have the payee. We have the drawer, we have the drawee, and we have the payee. So who is a drawer? This is the owner of the account who writes the check. So that's the drawer. That's the owner of the account, the person that is writing the check. The drawee, this is the bank that requested to pay the amount. So your drawee is the bank. The drawer is the owner of the account. Why the payee? This is the person whose name is written on the check to collect the money. That's the payee. That's the name of the person written on the check to pay the money. Okay, so that will take us to now. Before I take note, we have types of check, but that we might not be able to cover. We have open check, we have bearer's check, we have closed check, we have posted check. So we have a lot of types of checks. We have slate check and them. But for the purpose of this class, we'll not be covering that. So let's go to the next source document, which is the debit note. The debit note and the credit note. So I'll be starting with the debit note. Now, what is a debit note? Now, a debit note to a source document sent by a buyer to a seller used in correcting an undercharge in an invoice. By now, you know what an invoice is. So your debit note is always sent by the buyer, a company, a firm, an individual might be the buyer, sending it to a seller if to correct an undercharged in an invoice. So for you to understand better, that's an example there. Company A, buyer, meaning company A is the one buying now, purchase goods worth of 20 million naira from company B, which is the seller. Now, company A would like to return goods to company B. So, company A buys goods worth of 200 million, but it's returning parts. There are a lot of reasons why it's returning it. Okay, so company A issue a debit note containing all relevant information, including purchase amount and VAT. So company A will fill the debit note stating the goods he wants to return and necessary information on the debit note and send with the goods to the seller, which is company B. So in doing so, it shows that he's returning the goods and the difference should be paid back to him. So that's why I said undercharged. So depending on why he's returning such goods. So a good example of your debit note is this. A good example of your debit note is this. So it is common in big industry who try as much as possible to tidy up their account. So remember, I said in accounting you don't shade. So if someone is returning back a commodity to you for one reason or the other, you don't go there and begin to shade the record and begin to cancel out what we've written before and write the new. No, documents are being used to show what is transpiring between your buyers and your seller. So if it's returning goes back to you, then it's returning it with a debit note to give you reasons why it's returning back such goods. So a credit note. So the next one we're looking at is credit note. Now, what is a credit note? A credit note is also a document issued by a seller. Take note, the note is issued by a buyer to the seller, but in this case, your credit note is issued by the seller to the buyer to correct an overcharge in an invoice. So your debit note is used to correct an undercharge, while your credit note is used to correct an overcharge. So you need these two documents. Why? Because you don't delete invoice, you don't cancel out invoice when it is issued. So once an invoice is issued and there's an error or there's a return of goods, depending on who is returning now, you either issue a debit note or a credit note, depending on if it's an undercharge or an overcharge. So let's look at this example so that you have a good knowledge of what this document does. So that's the seller sell goods worth of 1 million to company A, which is the buyer. However, 10,000 goods were found damaged due to some reasons. It is notified to company B at the time of the actual delivery. So company B is the seller, company A is the buyer. Now company A is returning goods. Out of 1 million, is returning 10,000, which it discovered as a result of damage made on the goods. So company A will issue a document called Debit Note to notify company B, while company B will now issue a credit note of 10,000 in the name of company A. So your credit note can be used to issue when few goods are supplied than are ordered, or when customers return damaged goods. So in this case, it is damaged goods that was returned. So the seller will now issue a credit note. So that credit note will show how much is returning back to company B, because it's returning out of 1 million worth of goods, it's returning 10,000. So it shows that it has overcharged the firm. So the difference between that, it will raise a credit note for that and return, so that the difference will be returned back to company B. So, and that's how the credit note and the debit notes work. One is issued. Your debit note now is issued when there is an undercharge, while your credit note is issued when there is an overcharge. Your debit note is issued by the buyer to the seller, while your credit note is issued by the seller to the buyer. So your credit note, once the buyer saw that the product is damaged, issue a debit note stating why it's returning the goods. And once the goods gets to the seller, the seller take note of that. You in turn will issue a credit note saying that he has overcharged the buyer because he's returning so good back. So the differences will be calculated and the balance will be written down. So, and that's how it also looks like. So we have the credit note, depending on what the company is returning back. So that which is the cash receipt tape. The cash receipt tape. So is a cash receipt tape is a machine that is used for calculating and printing off cash transaction details. So you see more of these in your service sector, or sometimes you see this in your stores that involve in buying retail, selling of retail goods. When you go to ShopRite, you go down to big stores, or you go to your eateries, your Mr. Biggs, your Tasty Fried Chicken, and name them. They have this form of machine that you, after buying some of these items, they just press in the list of items. But even when you go to your big stores like ShopRite, you see those machines there. So you just line up, they type in some cases they just use the item, swap it on the machine, and to record all those items you have bought and do the calculation. And when that is done, you see a receipt coming out. Yes, that's receipt, a form of tape receipt coming out. That is your cash uh, register tape. So it looks like this. It looks like this, something like this. Okay, so it is called your cash register tape. So this is also another source of source document. So this can be taken to the bookkeeper or to the accountant, showing that this item was bought and this is the receipt. So it is a form of receipt that shows that transaction has been made and that an item has been bought and cash is paid for it. Okay, so now for the purpose of you understanding more, this is an assignment which you are to do. So you have to do this assignment, go through them. You can get help from your textbooks, and you can watch this video back and go through them. So that's where we're going to stop today. So thank you for listening. So more videos will be coming out on this platform. So you can rewatch until you understand, and you can also forward your questions to me. So thanks for watching, and you can study more on all these topics. Thank you.